Hey everybody, how you guys doing today? AMC Bigums here. Hope you're all having a good day. So this video is going to cover the 2008 crisis. It's going to cover how they've evolved since 2008. It's going to talk about the crisis that's coming and how much worse it's going to be than the 2008 crisis. You guys, it's going to be bad. I just want everybody to be prepared and protect themselves because this world's already hard enough and we're already getting into economics. There's a lot I want to get into in this video, so I just want to get straight into it. If you guys don't know much about the 2008 crisis, this is a very, very informative document. It's 663 pages, but it will tell you every single thing that happened. It'll tell you about each individual bank, tell you about the shadow banking. It'll tell you about the CDOs, synthetic securities, talk about synthetic CDOs. But in case you guys don't know what happened in 2008, I have a whole bunch of stuff. We'll get into the right side here soon, but the left side is what we're going to talk about now. It is called a CDO. So these are mortgage-backed securities, and what they did is they took a whole bunch of people's loans, so they packaged them together and sold those off, of course. Well, they also had what are called synthetic CDOs, which was the banks taking what are called credit default swaps, and they would bet against or for those. Well, which is what you saw in The Big Short. So if you guys haven't seen the movie The Big Short, I highly, highly recommend watching it. Well, what happened is all of these ended up failing. The everybody defaulted on their mortgage, so these ended up crashing. Well, the banks had all of these synthetic CDOs betting on those to keep going, and then the banks ended up taking a massive, massive hit, and here we are to this day. Well, they ended up getting bailed out, of course. And what did they do with that money? Did they learn? No, of course not. They took that money. Did they fix it? No, they dug their hole 12,000 times deeper. They paid more people to look the other way, and they just made it way, 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 way worse. So first thing I want to do, I'm going to go over here and look into this. So we'll get into that in a second. But this is a document I'll put on the bottom as well. This is a couple people already knew that this was going to happen. This was released in 2007, so right before, people knew exactly what was going on. But like I said, so they were paying these guys to not look, to not rate these bonds trash when they were absolute garbage. And why were they doing that? Everyone gets paid up front, including the rating agencies. Well, these rating agencies are not regulators. Rating agencies are for-profit businesses. So what they would do is they'd go ahead and get boom, boom, all these extra little rating or all these extra little fees, and they could get 44% more by giving them the garbage ratings, and it was still legal. On top of that, rating agencies claimed no liability for being wrong. So why did they care? But that's one of the main things that happened. So what I'm learning also in this document that is very interesting. So a lot of people are going to bring up Lou, and this is what he was talking about with, oh man, he just signed it over to somebody. But I don't think this is what happened here. But financial guarantors are unique counterparties. This is another reason why this happened in 2008. Well, these guys are like insurance companies, and they take on the risks for other people, so they'll walk up and take on their obligation, the risk obligation. They don't have to put up any collateral. They just sign their name. One or few parties in the derivative market not required to post collateral on decline in value of contract. Only counterparty not required to post collateral, even in the event of a downgrade in their credit rating. Well, what ended up happening is you had a whole bunch of these insurance companies. And right now we'll go ahead and get into some quick with Citadel, because of course Citadel has some of these as well. Well, to lower their risk, which is one of the main reasons why I don't think that they have been margin called. Well, as you guys can see here, during this time, you had one of those guys. This is the post I put up earlier. This is one of those insurance agencies for those banks. Look at their leverage. These guys were taking on such leverage because they had these exclusions and this and that where they are allowed to take up so much extra. Some of these guys were 94-1 at the time. Well, the banks were like 12-1 when they defaulted. Well, think about that. They're 12-1 at that time. Nowadays, when you guys look at Goldman and Sachs, they're 196-1. You have banks that are over 100-1. Now think about that. They were 12-1 in the 2008 crisis. Why do you guys think inflation went from 3.4 in 2008 up to 7.5? Like I said, you guys, this is going to be catastrophic. We're talking, I can't even imagine what their insurance are. Now, when we're talking about all this stuff in the derivatives market, I want you guys to just quickly here to see the total of these derivatives. The national value of outstanding derivatives rose to $610 trillion at the end of 2021, you guys. There's not even that much money in the world. Like we were saying with these, they were taking these bad loans and they were just repackaging them, and they didn't care. And then, like I said, when some of these Bs would default on the bottom, they didn't care. The others loans would package it up and still propped it up, and they could sell the house and still make it buy. But then they would take those BBBs that all defaulted, and they would repackage those and sell those again. So it's like you. They sit there and keep on packaging money and loans and interest rates and interest rate bonds. And I showed you guys that 70% of this was interest rate derivatives. You guys, that's insane. That's money that's not even there. Or it's money that's defaulted. Like I said, this is insane what is going on. So if you guys go ahead and go back and read that first article that I was talking about, this one I'll put up. One of the things I want to show you guys is this is absolutely ridiculous. So during a hearing of the rescue of Continental Illinois' Comptroller of Currency Todd but I'm not going to read that part. They're talking about we have a new kind of bank. It's called Too Big to Fail, TBTF, and it's a wonderful bank. In 1990, during the era of federal rescues of large commercial banks, once the country's fifth largest investment bank failed, crippled by legal troubles and losses in the junk bond portfolio, the firm was first into the largest bankruptcy in security industry to date. When lenders shunned in the commercial paper and repo market, so like I said, you guys, they're popping up the repo market. These repo markets are propping these up, and we'll get into that in a minute as well. But what they said is they ended up, I'm not going to get into all of that, but what they said is in 1991, Congress tried to limit this too big to fail principle, passing the Federal Deposit Insurance Incorporation Investment Act, which sought to curb the use of taxpayers' funds to rescue failing depository institutions. FDIC mandated that federal regulators must intervene early when a bank or thrift got in trouble. Well, so these guys are literally using our money constantly to bail these guys out, and like I said, this is insane when they're doing this. Who knows? They told us they bailed them out one time for this 1.7 trillion. They ended up giving them 29 trillion. One of the things that I don't like about this, and I'm going to show you guys this, is so there's loopholes that they found. So it says there's two important loopholes. One of these loopholes is the Treasury and Federal Reserve determine that the failure of an institution is posed systematic risk to the market. Now, what I want you guys to look over here quick at is who owns the Federal Reserve. So you're talking about the Federal Reserve from September 2019 through 2020. The trading units of Wall Street mega banks, both domestic and foreign, is the contracts, took an cumulative total of 11.23 trillion in emergency repo loans from the Federal Reserve. Those loans were conducted by one of the 12 regulation Fed banks, the Federal Reserve Banks of New York, which is literally owned by mega banks including J.P. Morgan, Chase, Goldman Sachs, Citigroup, and Morgan Stanley. Well, those are the people who write all the ISDA contracts and are doing all the problems. They're in charge of the Federal Reserve, it looks like. And on top of that, they're the DTC, so they're the ones who are regulating all of this, letting this all happen. So like I said, you guys, this is like beyond ridiculous what we're doing, what we're seeing here. So then if you look over here on the right, it says in 2006, the Feds owned 0 mortgages, okay? So think about what we were just talking about. Now the Feds hold about 2.6 trillion in mortgage-backed securities. So see these things we just talked about. So they hold 2.6 trillion in mortgage-backed securities on its balance sheet. 24% of that is outstanding residential mortgages. Outstanding residential mortgages in the United States. Guess we didn't learn in 2008. Well, guess what, guys? All these numbers I just showed you are 5,000 times what they were in 2008. Guess what? So we just talked about all that stuff with the Federal Reserve and who owns them. The Federal Reserve's balance sheet just hit another record high. They will hit 9 trillion before they taper. You see what I'm saying, you guys? This is insane. It's these banks are still doing all of this. They didn't learn. They've gotten it way worse. Well, now that they had the synthetic CDOs fail, now you guys, guess what? They now created naked credit default swaps. So instead of CDOs, we now have CDSs. Now, one of the things I want everyone to look at this, advantages of naked credit default swaps. A naked CDS in the derivatives equation of short selling is the equivalent of short selling. Short selling allows an investor to sell assets he does not own and buy them back at a later date. Therefore, an investor short selling an asset expects the price of the asset to fall. They increase liquidity in the market by reducing lags associated with correct price discovery, i.e. the presence of short sellers reduce time it takes for markets to accurately identify a mispriced asset. Therefore, naked CDS increase liquidity in the market for credit default swaps and reduce market inefficiencies by causing mispricing. Well, first of all, that doesn't even make sense. We already saw what shorts do. So first of all, shorts sit there and they can lower the price, change the price. Well, guess what? They're doing naked credit default swaps. And so this is wrong. What it does basically is what they say is it adds liquidity in the market. And that is what I always see. Advantages of naked shorts. It adds liquidity. That's their only single defense. Is it adds liquidity. And it's like, okay, if a share is not there, stuff isn't there, you should not be able to continuously package and resell stuff that is not there. You guys, they've been doing that for 14 more years since 2008, and they just ended up making new terms and made them have different rules, but it's the same stuff. They literally changed one letter. Now, come over here and they want to reinstate total ban of naked credit default swaps. Whereas the naked credit default swaps was illegal for a good reason from the passing of the anti-buckle shop law in 1907 until 2000 CTFC Streamline Act. So like I said, you guys, people have wanted these to be banned, but here we are. Like I said, here we are, and it's way worse than ever. What they ended up doing. So what I want to do now quick is look at the 2008. So in 2008, what we had are hedge funds, okay? They have a total of $3.5 trillion. Well, what those hedge funds evolved into are what we call family offices. Because what happened was called the Dodd-Frank Act, and it regulated hedge funds from doing certain things. So they moved over to what we call family offices, which are unregulated hedge funds, basically. And they don't have to follow the Investor Act of 1940. And they don't have to register with the SEC. They don't have to file 13Fs. So they're basically unregulated hedge funds. So that's how hedge funds evolve. They still have hedge funds, but as you guys can see, there's $3.5 trillion right now in hedge fund assets, 3.8-ish now around, and there's $7.6 trillion in family offices. So now you have synthetic CDOs. They changed them now to CDSs. Credit default swaps, and they put them into what we call now ISDA, which is worldwide. Now this is all again done by guess who? The banks. All the banks run ISDA, and they're the primary members. Now, market makers can come up to them and get synthetic shares, as I've showed you in other videos. So what they're doing is using ISDA, the credit default swaps, and they're making synthetic shares with those synthetic securities. It's the same thing. Now, they also, back then, they had the CDS that we've been talking about. Well, now what they have is what we call the CNS program, Continuous Net Settlement, that I've showed you guys before. They can take out securities. It doesn't matter what they do. It's Continuous Net Settlement. Other people inside of that, that are inside of the net, can say that they're putting it in over to it. Whatever you do, whatever you take out, you get one position. One short position, no matter how many things you take out, and it's one net short position, so it's just money. So again, you can create synthetic shares. And on top of that, as I showed you guys before, market makers have exemptions through these rules where they're allowed to hold where they're allowed to hold shorts positions as well until a determined time, which is when there's significant trading volume. Well, what's that mean? That's just by interpretation. So, whatever. Nowadays, you have payment for order flow. Back then, they have DTC, so they had self-regulation on the banks. Well, guess what? We still have self-regulation on the banks. The DTCC didn't go anywhere. As you guys can see, they actually got their hands in more stuff. And now in the Federal Reserve, they actually grew. So that self-regulation actually grew 10 times over. Now on top of that, now what we have is called the OTC market. Internalizers, ATSs, dark pools, things of that nature. And then on top of that, you had the banking shadow market, which I was talking about in that first PDF there, which is, like I said, these banks should not be having markets where none of us can see everything. They should not be able to have a dark pool, and they're the only ones that can self-regulate their dark pool. There's an element of price discovery inside of the dark pools. Elements such as Goldman Sachs, blah, blah, blah. Like I said, Morgan Stanley, they got their own dark pools. They're able to monitor and regulate their own dark pools. So what, like I said, is just crazy. On top of that, you got market maker exclusion 203B. Requires a broker bureau to locate a security before engaging in a short sale transaction. But guess what? Certain exemptions, when a market maker is engaged in bona fide activities, they can bypass that. So like I said, you guys, they took all these rules and they've changed and they've grown and they've learned and they've made it way, way, way worse. The inflation was 3.4 in 2008. It was 7.5, and they still want to raise stuff. Like I said, you guys, it's unsustainable. What I've been telling you guys, it's unsustainable what has been going on. So now what they're doing, as you guys can see, instead of the CDOs, you have synthetic shares now. Now think about this. They had synthetic CDOs because they thought, hey, they're mortgage-backed securities. They can't fail. Well, guess what? They control the stock market price. So they can control which stock, as you guys can see, shorting, they can control which ones fail and which ones don't. So they think in their mind, hey, we can control that. They're too big to fail. We can control the market. We make sure they don't fail. So we can create synthetic shares. Now, the DTCC has all the real shares, like we're showing you guys in the CNS video. If you guys haven't watched that, please go back and watch that video. Now, they have the real shares. You have ISDA contracts because the banks are, because they have the real shares technically, like I said, worldwide, they're able to move things, all sorts of stuff. They have basically the next thing you would call the closest to a real share, because market makers can go to them through ISDA to get more shares, as I showed you guys, even when they don't exist. Then you have the CNS program. Well, they can take those shares, and what do? They can pass those down to retail, pass those down to retail, pass those down to retail. Why? Because we never know the true total. Think about that. That Say technology or whatever. The second we had numbers coming up, boom, they bought it. No, get rid of that. Why? Because we can never truly get enough people to say, hey, we own this much of the stock. Truly, why? It'd be market manipulation if we all talked about stuff like that. So, like they said, this is technically their new, mortgage-backed securities, it's too big to fail. Well, guess what? That's why I told you guys, they never expected buy and hold. This whole system was designed, all right, well, now we can continuously funnel money out of stock market. It's too big to buy, it's too big to fail. They'll never figure out buy and hold. Well, guess what we did? So things, as you guys are seeing, are starting to collapse around everywhere because they cannot sit there. If the market's spread thin, it's very, very easy to lower prices and nobody would notice. They wouldn't even blink about it. But we all notice because we're all holding one stock. So like I said, it's very easy when you're spread thin to keep the Ponzi scheme going. Now, one of the things I want to go over here and show you guys quick is how the market's set up to steal from us, create those synthetic shares. So if you wanted to have a fixed easy, it's a very, very simple. How you can have an easy, non-corrupt market, but they will never have it like this because rich people won't make money. But the way you have it set up, like I said, you have a retail, you send your order to a broker. What should happen? I'll get into what should happen here. So that broker now sends it to a market maker. If it's a payment for order flow market maker, he now sends him a little cash. Well, that market maker now has this many abilities. You guys think about that. He has this many abilities to fill that order, and this is the only one retail sees. This is it. All this stuff is hidden. This stuff is on level 2 or like level 3 data, and this is on level 4 data, level 5. Like, no, we don't see that. Like I said, think about that. That should not ever happen. A market maker should not be able to do that. And retail, we can sit there and route our orders to this so that the market maker has to fill them there. But as we're finding out, the NASDAQ, the New York Stock Exchange, they're corrupt. So you only really have the IEX, the LSTE that aren't super corrupt. And that's why when you see they don't have, the shares in there, you'll see your orders get canceled compared to everywhere else is just, oh, it's insta-fill. Why? Because they're all liquidity providers of, oh yeah, Citadel, the market maker. So it's the same thing. So like I said, you guys, you got to make sure we're going to IEX when you guys do direct route, unless you have no other option. But like I said, you guys, you're seeing this. It's insane. One of the things I wanted to show you guys here as well, it was super important. Of course, if I hear this. So one of the things we were talking about also was those repo markets and how the repo markets and these banks are being propped up by them. And I showed you guys the treasury yield. The treasury yields went up higher in the last 2 years than any stock. So like I said, they're sitting there propping them up. Well, on September, this is actually pretty crazy here. Is this the right one? Hold on. No, I don't think this. Yeah, this is the right one. But here, we'll talk about the repo one. But this is the thing I want to show you guys. But so the repo. So exactly one day before the Federal Reserve would embark on its first emergency repo loan of a 2008 crisis, one single name blew up. The dealers in these credit default swaps were very the same trading house. Blah blah blah. It said the next week, tens of billions of dollars in the repo loan from Feds in an operation that grew to a cumulative 11.323 trillion before the conclusion of July 2020. The Feds pumped in a cumulative 4.5 trillion in repo loans into Wall Street's trading houses. Just in the last quarter of 2019, you guys. So in 2019, the Feds pumped in 4.5 trillion in repo loans into Wall Street's trading houses. Think about that. Like I said, you guys, everybody was sitting there, oh man, the government's going to do this to Doge. They've known about this. They're still propping it up. That's what's crazy. The government's been helping these guys out forever. These guys have just been making paychecks. Instead of showing you guys all this stuff, the Federal Reserve, the Feds now own all these. Think how scary that is, you guys. You guys saw the banks failed. We have a fiat currency. This is what I keep telling you guys. If the United States fails, all these fail, now what? The United States takes a massive, massive hit. Now what? If the stock market crashes, are these going to crash again with them? Yes. Why? Because a lot of these, it's the same stuff. And now you already have the pandemic. People already don't have money. And now you're going to throw a crash inside of that, you guys? This is what I'm saying. You guys, you got to be ready for what is to truly come. All the numbers are right in front of you. They literally just changed one letter to make it from 2008 to make what is going to happen. It is very, very scary. Where is that thing here? Okay. Here you go. This is what I want to show you guys. All right, so here you go. The New York Fed is also responsible for, so not only do they have the reserve, all that Federal Reserve, these banks, right? The New York Fed is also responsible for sending its bank examiners to these same banks to make sure they aren't plotting some evil scheme that will bring down the U.S. economy, as they did with their derivatives in the subprime debt bomb in 2008. Unfortunately, if a New York Fed bank examiner doesn't listen to the relationship managers at the New York Fed and insist on giving a negative review of Megabank, she can find herself fired, as New York Fed bank examiner and attorney Carmen Saraga found when she went up against Goldman and Sachs. So like I said, you guys, they're all working together. Anybody that says anything, they just fire them. then their bosses cover it up. So as we can see, they didn't learn, they didn't fix 2008 crisis. So everybody that's like, oh man, the 2008 crisis was fixed. No, it wasn't. Not only was it not fixed, they just bribed more people, and the rich guys, more rich people stole that money. And it's the same thing. And they're just throwing more stuff into swaps. And meanwhile, all these bankers, while they're doing all this stuff, guess what? They're over here giving themselves $35 million bonuses in the meantime. $34 million bonuses in the meantime. That's where it's all going. It's going to these guys as bonuses. Just their bonuses. Think about that, you guys. So like I said, this has been going on for how long? You have the 1%, as I made those charts the other day. If you look at the world economy, the United States is going to fail. It will fail hard. And I'm going to tell you why right now. On top of all of this going on, If you look at the world economy, let's just look at the world economy for 1 second, okay? I'll go ahead and pull up one of these sketch pads. We're going to go ahead and do another one. If you look at the world economy quick. What the heck is this stupid chalk thing? Give me 1 second. There you go. All right. Now, if you look at the world economy, you have the lower class. You have the actually the lower class. Let's make that a little bigger. So you got the lower class. You got the middle class, which is now about that. And then you got the 1%. This 1% has more money than these two combined by like thousands times over. It's not even funny how much more that 1% owns than all of us combined. Now, when you have the 1% and all of that is all that money right here, right? They're not putting it back into the economy. You know what they're doing? They're funneling it out to the Cayman Islands. They're doing all this stuff to avoid taxes, to move it into family offices, to do unregulated stuff with that money. So they're trying to get their regulated 1% money into unregulated, unviewed, corrupt money. Well, so that's not trickling back into the economy. Taxes now, they're not paying their taxes on all that money that's leaving the United States. You know who's been fronting that bill? These guys and these guys. Well, these guys, now inflation is kicking in and it's hitting these guys and it's hitting these guys. So now you're going to start seeing this much of the brick go over to here soon. Okay? Well, now the lifeline of your economy is your middle class. They're the people that go into the economy and spend money. Why? Because these people don't have money. These people spend money, but they spend it at, like, I don't know, fast food to get little things that they need. They don't have money that's going to go out and support businesses. That's going to be your middle class and this. Well, they're hoarding it all. Well, if you suddenly take this and keep killing this away and get rid of that, you're literally going to have the 99%, which is all poor people or lower class. And then you're going to have the 1%, and that's literally what's happening. Why? Because they're stealing everything in the stock market, the derivatives market, people that have defaulted on, like, you don't even know. People were losing houses in these CDOs, these guys that were at the top of the thing, they were paying their bills on time, you guys. They didn't do anything wrong, and their house got stolen because the banks just decided to go and pop them in with this other stuff. Because when they signed them up for the loan, they didn't tell them what it really was. So they would sign them up for that type of a loan. Like I said, none of us knew that stuff. So people that were paying their bills on time lost it all. They stole from them and they didn't even care. They're still giving themselves $35 million raises. Like I said, you cannot have this suddenly be the lifeline of the economy because you've already killed them in inflation. You're killing them in everything else. And then all Powell's going to say is they can still drive to work. They can still eat. So whatever. Inflation only hurts people that live paycheck to paycheck. Like I said, your government's saying they don't care. You're seeing the government prop this up, you guys. And it can't. Look at this. Look at what I'm showing you. This is the only course that this can take. And this is why the Powell says, you guys, we have no answers. Why? Because the way our system is designed it's to the point where, 10 years ago, the blocks were so much, wider that you could take from them. You had your lower class. Think about it back in the day. This is what I keep telling you guys. Your middle class was huge. So your 1%, this, whatever, they could sit there and take from that because it was so much bigger than it is now. It was so much stronger. Think about when your grandparents, that's what's sad, you guys. Our technology has gotten so much better. But our way of life has gotten so much worse. When your grandparents, one man could work while the wife stayed home or whatever, either one stayed home and took care of the kids. And they could still be in this middle class. We have us all working 2 jobs. And we're barely even struggling to stay in this class with 2. Let alone with some of you have 3. Like I said, the way of life has gotten worse since our grandparents. Technology's gotten better. But our way of life has gotten dramatically worse. And then I showed you guys competition in the world has died off. Monopolies weren't allowed to happen. But yet you see they kill competition because they can short companies into the point of oblivion. And then they can take their patents and kill any competition in the United States. What the United States was built on was everyone had a fair chance. Everyone Competition was worldwide. Now competition is between the 7, 8, 15 companies that own the United States and what they allow you to make. Because if you get too big, they'll short you to death and they'll take your company. Like I said, everybody sits there and talks about being a socialist. No, the way the system was designed was to funnel money from the middle class through the stock market, through the bonds, through interest, through mortgages. How can you put your money in a bank and only get 1% a year? What, $10? But they charge you $12,000 in interest? How do you grow your money? Oh wait, you can't if you're in the middle class unless you put it in stocks and bonds. Well, guess what? They're stealing from you in the stocks. So there's no way for the middle class to continuously grow their wealth unless they play the big boys game and they follow what they're trading. They do quick options and take the crumbs. Why they're making millions and millions. Like I said, this world cannot sustain itself. Eventually, you will literally have no middle class. Your middle class will look like this. Just like your 1% looks now. You're going to have it look like that. And then you're going to have this. And these guys are going to go, what the fuck is the difference between us and any of these other countries that you guys bash so hard? You have this small of a group that rules it all, and this is all right. And then you got that. Like I said, you guys, every time I talk to you, how do you enslave a nation? There's two ways. Your president's told you: the sword and debt. This is enslavement through debt. You didn't see you see the sword in your face, you're gonna fight back. You don't see the debt in your face. It's not your natural flight or fight response kicking in. You fight back. You have your cell phone in your hand, glued to it, YouTube, all these other things. That's what you're staring at. You're watching media. You're only getting information that the 5 companies that I just talked about want you to know because they own them all. They censor everything. We're supposed to have freedom of speech, but yet they censor what we say. You got cancel culture, canceling people for words that they say. If you don't like what somebody says, don't listen to them. That's part of America, to have the ability to talk and do and dream and be able to pursue those. But the problem is the American dream has been bought and stolen for by 5 or 6 companies, thieves. They're literally, as you guys see, running drugs on ships. They're the modern day mafia. And what are we doing about it? We all been just gotten our participation trophies and soft. And could you imagine what people would have done back in the day? What is our government doing for us at this point, other than propping up these thieves? You guys just saw Credit Sus was holding all that money for cartels. That's no different than us aiding and abetting. But we would have went to jail for that for 15 years. You know what they got for that? They got a $35 million raise. You guys, this world is not right. It cannot sustain. Like I said, this is not doable. It's not. And then the problem is you have fiat currency. So when this does crash, this is why I tell you guys, all of us are broke. This is what the 1% doesn't get. When this crashes, it's going to be like 2008 if you were in the right spot, just like in The Big Short. If you watch that movie, Brad Pitt goes, now you're rich because he told you where to go in the right spot. This is why we tell you guys to play certain things, to do certain things, get in those right spots. So when this crashes, you're on the top of making money because you have these trenches because they all need to be paid back. That's the thing. These all need to be paid back. See, these get paid first. When we own these trenches, they still need to come down and pay us. Like I said, guys, that they can't get out of this. Buy and hold was they never ever thought we would have figured it out. And if they did, they wanted it market manipulation, then they could charge us. But like I said, the problem is too much information got out too fast. Too many apes dug out and exposed too many secrets too fast. Too many lawsuits. Too much public information was out there that these media guys didn't think we would go after, and they didn't bother censoring right away. Well, it's too late now. We've already read the lawsuits. We've read the filings. We've read the SEC stuff. We read the overstock lawsuits. We know everything they're doing. I'm showing you what they're doing. Like I said, $610 trillion. When this, if you guys truly think about it, all money in the world is worthless because every country in the world is worthless. All these companies that have, even Apple, all these companies that have so much money, look at how much debt they have, man. Look at all this debt these guys have. Other than like the select 100 grand emperor companies, think about the rest of the world. Everyone's in debt or has bonds out and owes them in some way. Like I said, it's just insane. The whole world can't be in debt to 25 names, to 100 companies. Like I said, this is crazy, you guys. This is not doable. Eventually, people are going to wake up and fight back, and that is what this is all about. So don't sit there, like I said, don't sell yourself short in a once-in-a-lifetime opportunity. This is a moment where we can say no. Hey, when you guys don't have that money, guess what? That's when they go to jail. The reason they didn't go to jail in 2008, the reason one guy did, is because they still had that money the second it happened. We bailed them out, and they didn't learn their lesson. Like, as you saw, not only did they learn their lesson, they got smarter. Like I said, we watched these guys put all this money and this time and all this effort into being able to manipulate stock, front run. They do satellite dishes. They gain all this technology to be able to cheat the system instead of just play it fair. Think about how easy a fair market would be, you guys. Let me show you how easy it is. Take me 2 seconds to show you easy. This is how you make a fair market in 10 seconds. So, you have, I don't know, 10, 12, 13, 14 brokers, right? We're just going to make some squares here. These are all the brokers, okay? Instead of exchange, and then they have their exchanges, okay? Whatever. Can you make boxes quick? Now, you have, let's say, 10 exchanges, 10 brokers, 12 brokers, whatever you want to do. Well, you have one platform. You have platforms all over. I don't really care. Each one of these got their own little platform for retail, okay? Now, retail is going to have to download. Who cares? Do we care? No. We have how many applications on our phone right now? Do any of you care? No. So retail would have to download 5, 6, 7, 8, 9, 10 apps, whatever we wanted. And each one of these would only have a certain amount of liquidity or shares that they have access to. And then on top of that, just like everything else in the world, guess what? There should be technically a limit on what you can make. There's a limit on what everyone else can fucking make. We all walk up and we get our limits. Minimum wage, this, whatever you say, we all get capped. But they don't. Like I said, they can make whatever they want, and then when they don't make enough, what do? They package stuff up and sell it in some OTC market, into the derivatives market, in money that's not there. And guess what? By shorting that, you have access to money that's not even there. Think about that. You have access to money at a whim when it's not even available. Okay? So this is crazy. But like I said, now that one retailer, if you have the IEX, guess what? You order the IEX, there's not liquidity in there, your order gets canceled. Well, guess what? Then you go to this one. Then you go to this one. Now, why would this work? These guys would all have to use competition. Competition would suddenly be back in the market. Oh my God. Crazy. Which would help retail. It would help our spreads. Crazy. Now, on top of that, they're still getting money for every single trade. Well, guess what? You guys saw the market makers. How much does Citadel make? By just taking a little off the top of each trade. So don't tell me that, oh man, they're going to be hurting. Oh, you're a socialist because you're trying to cap what they can make. I don't care if I'm trying to cap what these guys can make when they're giving themselves $35 million bonuses. Jesus, people. Holy crap. I don't care what you do in the world. Nobody's contributed so much, they need $190 billion. Good one. I said, good God. There's only so much money in the world. Or you have to print it. And every time they print it, inflation comes up. So what? You have one or two choices. You either need to say, all right, you guys, Jesus Christ, like I said, they've stolen so much, they owe $610 trillion. At the end of the day, they're not even rich. They have fake money that they're able to buy stuff with. Because it's really, if you look at it, worthless. So, like I said, you guys, it's going to come crashing down. Because why? We're waking up to it. That's what's the difference. The 99. When does this come down, crashing down? When the 99 realizes the American dream has been stolen and bought and paid for, and all the government officials were ex-lawyers that wrote laws to make everything they're doing legal. They are legally stealing from you. And when they get caught, guess what they get? Acceptance, waiver, and consent, and a fine of 500 to, which is an equivalent of like $5 to us. They get 500,000, couple $1 million when they just stole 100 million. Do they care? You have people who are out here selling marijuana. People out here doing small, petty crimes. Oh, he grew a plant. Oh, I don't even know, man. Didn't pay child support one time, which, whatever. I don't even know. I can't even think of those small, petty crimes. But, you know, you get that. We go steal some candy bars. You steal a candy bar a couple times. Boom. Feed your kids, family. Steal some food. Guess what? You're going to jail for 15 years, 10 years. Oh, okay. Meanwhile, these financial terrorists are literally crumbling America from within, as we can see, as you're not even going to literally have a middle class. It got stolen from. Generational wealth has been stolen and no one cares. Like I said, man, be prepared. How do you get prepared? Look at what these big companies are doing. BlackRock. Okay. They're buying up mortgages. They're buying up land. Why? Because when fiat currencies are worthless, guess what happened back in the day? Land and property was worth a lot of money. Hard to obtain it when you have no money, and the money that's available is worthless. It's a commodity. Yeah, it'll lose some value, but it'll gain it back. Land will just go up way more. Got precious metals, gold, silver. There's a whole bunch of things when you look at it, because in the end of the day, we see fiat currencies don't work when everybody steals. So in the end of the day, you're going to have to go back to either a gold standard or some kind of standard of some kind, or you're going to go back to a fiat currency of some kind again, but you're going to have to make sure it's regulated. It's like actually regulated. So trust me, bros, can't happen anymore. In God we trust, as it says on the coin, because you can't trust in your government, as you're finding out. So I said there's things that you guys can look at, get into. So if the dollar fails, yes, for a while it'll go down, but it'll go roaring back up, or it'll go roaring back up because, like I said, prices of house, most of these are going to go down. When this crashes, houses should go down, and then at that point, like I said, it'll go right back up because commodities. So said a lot of things you guys can look at, but like I said, be prepared for what's to come. Because if anybody thought the 2008 crisis was fixed, you are very, very mistaken. Just like everything else, they evolve. So thank you for watching. If you watched to the very end, like I said, you guys, this is very, very scary. Now, before I go, actually, let's talk about AMC and why I tell people to be in these. Like I said, if you guys look at those tranches, they bet on AMC to collapse hard. And like I said, at the very start of this, it made sense to do that. We saw on the Q1 posting, they only made, $100 million globally at this time last year. That was a good bet. That bet's now changed. It's just like in The Big Short. When they bet with these synthetic CDOs, they bet on these the CDOs. Well, guess what? Now it's a bad bet, just like these were. So it's gonna, like I said, it's gonna be crazy when we see what actually comes out and how many of these shares come out. But when you see the order of how they're gonna get paid out, I'd rather be up here when AMC, GameStop, these other super, super shorted stocks than be down here. So, like I said, guys, thank you for listening. Like, some very scary stuff coming here, you guys. Very scary stuff coming. Our government is just a joke. Everything around us has been a complete joke and a sham. And when we start realizing that, like I said, that America we read about in the textbooks is gone, people start waking up and realizing, there's more to life than CNN, Fox News, and Democrat and Republican, and realize they all are the 1%. They're all getting millions of dollars for paid speeches. But thank you for listening, and have a good night, guys.